Good afternoon and welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We'll look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll take a quick look at the US dollar. We'll see how it's affecting gold, silver, and the cryptocurrencies, and then we'll move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat message in the chat tab. I'll be more than happy to go ahead and take a look at it when we get a chance. If you like what you see here, you can always follow me on Twitter under the name Stock Darts. You can find these videos on YouTube under the same name, or you can visit me at patreon.com/StockDarts, where I post weekly blog content including trade ideas, watch list ideas, as well as the reposts of these Wednesday market reviews. Those that are regular members would have had a couple of good winners that we had this Monday, which we'll try to cover a little bit later in the stream as well. Other than that, let's go ahead and get started. The first thing we're going to do is take a look at the S&P 500 through the ETF SPY. As you can see, we're grinding right up against all-time highs. I mentioned last week that we are at a pretty key inflection point in the overall markets, and that has not changed at all. We are right up there, pressed up against the roof again, or the ceiling. And at the moment, it actually looks like the bulls really want to go ahead and try to push this to new highs, and possibly even start a new leg up in this rally. I've been a little skeptical of the market for a few months now. We have been, despite the fact that we keep coming to new highs, we've spent the majority of the last 4 or 5 months trading sideways. If you go ahead and take a look at all the way since back in February, we spent from the beginning of February to about April trading sideways, chopping, and basically just grinding traders. And then we had a maybe 2-week window of good price action, and then we've basically spent the next 2.5 months trading sideways as well. And so despite the fact that if you look at the overall markets, things are looking pretty good, and generally speaking, the price action has been benign to those that maybe are holding long term. To those that are swing traders or those that are trading in a more short-term time frame, it's actually been very difficult. There's been a lot of back and forth and a lot of choppy price action, and hopefully we'll see a kind of a resolution to this in the near future, where we get a little bit more predictable price action, and that could be the case if we break out, or it could be the case if we break down. And so that's why I think that we're at a pretty good inflection point here, is because one way or the other, we're going to get a little bit more predictable price action in the very near future, once we really kind of come to terms with what we want to do with this ceiling that we are challenging right now. Like I said, I colored this line green last week because, again, it's a very bullish point. If we can break past it and sustain that breakout, then that's going to be a really good sign for the markets, and I think it's going to be another leg up, and maybe we see another 1 or 2 weeks of action like we saw at the beginning of April, where we just kind of rally unimpeded for maybe 10, 15, 20 days. If we reverse here and head lower, well, we've got a lot of support levels that we're going to go ahead and try to challenge, and the longer we grind up at these highs, the more likely it is that when we do come back and test these support levels, that they might just hold, as the bulls will be a little bit more sort of confident in defending the price action. We've hit a pretty big wall of supply, and so far that has not really caused a lot of selling pressure. Pretty much all the supply that's been overhead has been bought up by the bulls, and at the moment it looks like there's still enough demand to go ahead and push this market back towards the highs, which of course is what's happened. If we look at the S&P 500 in a vacuum, now we're going to have to go ahead and take a look, of course, at the 4 market indices and see how they react and see exactly what the key levels are on all of them, and try to understand exactly what the difference is between the 4. But as far as the S&P 500 is concerned, this is actually a pretty bullish chart. Typically what you have when you have a range of consolidation like this is you come up, you bump into highs, and then you come down and you test support. And eventually when you're getting ready to break out, the pullback doesn't come all the way back down to support. It's a really shallow pullback, showing the buyers are beginning to change their opinion on what exactly good value is, and that sets up for a possible breakout beyond those levels. And that's what it looks like we're setting up for right now. If you go ahead and take a look, the moving averages are all aligned pretty well and starting to curl back upwards, which again is indicative of the possibility of another further rally. And so what it looks like right now, like I said, is like the bulls have taken back control of the price action and want to go ahead and start pushing it past it. Now, what are the levels we need to watch in case this doesn't occur, right? What if we do falter and we head right back down? Well, this little clump of the 20 and the 50-day moving average is around 415 to 410. That's going to be our first key support. And again, that's a very shallow area and very likely to hold, and then maybe another attempt, depending on the nature of how we try to break out here. And if we fail here, there's a pretty good chance we lose the moving averages as well and maybe have to head down. As you can see, 411 is going to be a really short-term level as well. But I think the key is going to be as we kind of come down and start challenging this trend line and then this little 3 or 4 candle pattern that we had here around 405, which is where the last level of support held. Now, I think the support is more a function of the moving average, of the 50-day moving average, than it is of a horizontal price level at this point. So I don't know that this will be a major level. I think the next major level is way down here, 400 to 398. And I think if we do have a stronger correction, we're going to head back down to this level, right below 400, right around 398. And this will be probably the important line to defend. And you can see I still have it colored red from the last time that we needed to challenge it. And you can see we didn't actually come down and test it. So things are still looking pretty good as far as the long-term picture is concerned. We're still heading into the summer months. I still think there's a pretty good chance that the market is going to still taper off here and start trading sideways. But it's looking like that sideways trading action maybe isn't going to be as volatile as what was beginning to look like as we were heading into the end of May and beginning of June. Again, things have quieted down now. Volatility is cyclical, and this is something important to keep in mind. It's part of the reason why I say that we are at a pretty key point here. If you look at the height of the candles here, right, they go from really narrow as we have the kind of the nice little short rallies, and then really volatile as we kind of go back and forth, and then they get narrow again, and then they eventually get volatile again. You'll notice over the last 10 days or so, we've had really tiny candles as price action has narrowed down. This is, again, hinting at the possibility of volatility coming in the very near future. Now, volatility doesn't always mean that it's going to be a correction. Sometimes you have strong volatility and breakouts. Matter of fact, if you go ahead and take a look, typically when you have these tight corrections right before a breakout, you see range expansion as the candles kind of get a little wider. Now, it didn't happen too big here, but the first couple of candles are usually wider as you get volatility expanding to the upside. And so I think the key here is that we're going to see volatility in the very near future, whether it could be the end of this week or the beginning of next week, but we should begin to see some big candles, and they might be green to the upside or they might be red to the downside. Now, if they are green to the upside, well, we don't really have any targets because we're at all-time highs. And I think the big key is going to be not necessarily what the upside is as much as what happens when we break out. Do we hold this breakout and continue climbing, or do we falter and head right back below this green line? I think if we make a big green candle and we head right back and we fall below 420 or so, I think that's a pretty negative sign and would likely mean that we slice through these moving averages. As long as we hold above this 422 to 420 area, though, it looks like we're going to go ahead and continue to stair step. We're going to do basically what we did here. I'm going to go ahead and pull out the rectangle tool, which we like to use here. And again, you can see we've been sort of just stair-stepping along. You can even go ahead and maybe draw another rectangle here in this area. And we've just kind of consolidate, trade sideways, go up, trade sideways, go up, trade sideways. And it could be that we're ready for another leg up and then eventually another rectangle somewhere up here as we trade sideways again. And so overall, things are looking better this week than they did last week and the week before that. For those of you that are regulars on my Patreon page, you'll know that we mentioned that this week, that it looked like things were starting to get a little bit better, and we had more setups this week than we've had maybe in the last couple of months. And if that's going to continue, then that should bode well for us as far as trading is concerned. Like I said, this is a week where we are not only seeing more setups, we're seeing the setups actually work. And so I think it's indicative of a market that's starting to improve and maybe getting ready for another potential rally. And like I said, if it doesn't rally, well, we understand now. We know what levels we're looking at, and we know what levels will indicate whether that's going to work or not. And so keep in mind, 422 If we break out, we should not lose that. If we do lose that, that's a negative. If we do, if we don't break out and we pull back, keep an eye on the moving averages. And if we lose the moving averages, then keep an eye on a couple of levels. One is going to be 405, and then the more important level is going to be around 398. All right. Now we take a look at the Nasdaq. You can see it's still kind of, relatively speaking, lagging behind the S&P 500. We're not at all-time highs yet, and we're still kind of dealing with the catch-up and trying to catch up to what the S&P 500 and the Dow Jones are doing. Now, this is a larger pattern that we've seen in play already quite a bit. And it's a function, like I said, of a market that's starting to kind of come to terms with the fact that we are more vaccinated and more willing to be out in the open, and so we're seeing still that rotation away from tech and into other areas of the market that were maybe hit pretty hard in 2020. And so the tech sector is still kind of lagging a bit. Now, that being said, I've seen some signs of improvement in this area, and we're starting to see some stocks recover and start to show some potential upwards mobility. And if we continue to see that, then I think it's a good sign that tech will kind of catch up and start to print new highs. I continue to still look at tech names. Despite the fact that they're lagging, I still see it as an area that is worth buying because there's good value, and it's still an area that we can probably focus on a little bit more. All right. Real quick, I want to point out the FANG stocks. So we can see some of that momentum starting to pick up in the tech sector. You can see Facebook has actually recovered very nicely and is already kind of right back up at highs. If we go ahead and take a look, Amazon also is starting to pick up some steam. You can see that it is starting to move up as well, up to its 50-day moving average. Now, of course, it's still lagging compared to the overall markets, but it is picking up and starting to kind of work its way back towards the top of its range. And for those that maybe didn't see this the last few weeks, I could still consider Amazon to be one of the key indicators as to what our market is doing. And the fact that it's been sideways for so long, I think, is part of the reason that the market has stalled out, or we've been kind of a little bit slower to rally over the last month or so, or last several months. And if it can pick up and start to make its way back to highs, I think that would bode well for the overall markets. Apple, which was one of our trade ideas this Monday as well, has done all right. You can see it's struggling, but it is kind of bottoming out and starting to make its way back up. I think Netflix is one of the ones that's still kind of struggling. And again, this is probably the one that's the most representative of what exactly 2020 was and what kind of stocks did well. So I think that this is still showing that traders are expecting some of these tech names that really benefited from 2020 to kind of stall out, and that's what they've done. And then finally we have Google, which has been kind of on a strong uptrend all year anyway. And so as you can see, we're starting to see a little bit more strength across the board on the FANG stocks, which is of course starting to reflect in the NASDAQ and the Qs, which are beginning to make their way back up towards highs. You can see it's the leading index right now today. It's up 0.37 as opposed to the others that are pretty flat. Not really that big of a difference, but showing that there is a little bit of momentum and it wants to make its way back up. Now, what are the key levels we want to watch on the NASDAQ? The first one is going to be these highs here around 342.50. Obviously the all-time highs, and it's going to be the same thing as the S&P 500. We need to see what happens as we hit the ceiling and whether we are really capable of breaking out of this level or whether it's going to be a little bit of a stalling out area as we kind of falter and maybe deal with this overhead supply that we've been dealing with for a couple of months now. You'll note the moving averages are not quite in the same place as the S&P 500. The 20 is still below the 50, although it is curling right back up, trying to cross back over. So this is really an alignment that's more indicative of a range-bound price market rather than one that is ready to go ahead and rally again. And so we still need to see a little bit more constructive price action before we can really expect a stronger rally to come. And so we'll see what happens again as we kind of come up and test these highs. And so that's going to be a key area. We can go ahead and draw our green line here as well. And you can see we already have our red line, which again we've kind of violated recently when we kind of fell back down here in the middle of May. Now, if we see a correction in the markets, if we do pull back, then we are likely going to come back and test this red line again, and maybe even fall a little bit below that. We'll see how we behave with the Nasdaq and whether it continues to gain strength. I have a suspicion that if we see weakness in the market, we'll probably see it in the Nasdaq first, probably the small caps first, but the Nasdaq as well. And if that's the case, then we're going to violate these shorter term levels right away, which is the 50 and the 20, and this short term support level around 330, and probably head right back down to 325, and then possibly even below it, and maybe even come down to the 200. So I think that there's still room to the downside if we correct. However, as I said, it looks right now like the market wants to push higher. So I would suspect that we come up and challenge this 342 area before we head down and challenge the 324. And so I think that there maybe is another day or two of green action before we really see the resolution at these highs and what the market wants to do and whether it's really ready to kind of break out and push upwards through these areas. Now, if we look at the Dow, you'll note that it's actually, in the intermediate to long term, it's still relatively speaking strong, but in the short term, it's starting to lag a bit. It's not at all-time highs like the S&P 500, and the last 3 days are actually red, unlike the Nasdaq, which has been green, and it's kind of flattening out. Now, does this mean it's topping out? Not necessarily. I think maybe it just got a little bit ahead of itself, and it's just taking a breather while the other indices kind of catch up to it. And if you look at it in a vacuum, nothing that it's done here is indicative of a bearish market or an equity that's ready to go down. We've got the same range, and as I mentioned before, one of the patterns that you'll see, it's a very prevalent pattern that happens quite often when you have a market that's going through these phases, is when you get range bound, you test the highs and the lows back and forth, and when you're ready to break out, you don't come back and test the lows. You instead just pull back very shallow and build up a little bull flag or a little consolidation range, however you want to call it, just below the ceiling, which eventually is the staging point for the attempted breakout. And that's what it looks like we're setting up for right now. Now, of course, it could end up being that we roll right back down and this falters and breaks down. And if that's the case, then maybe we head back and test the lows. But if we don't see that, if we see this price action remain the way it is, and then we start to see a push back towards highs, it's a pretty good chance that that breakout will occur. Now again, if we do break out, there's still the retest of that breakout that's going to be important. But what it looks like right now is like we're setting up for a breakout, and like the Dow Jones is kind of getting ready to maybe follow the S&P 500 and start printing new all-time highs. Now there is a little bit of room to go, and we still have some work to do. But like I said with the Nasdaq, if I was handicapping this right now, I think there's a better chance that we come up and test these highs than test these lows within the next week or so. And then from there, like I said, it's hard to tell right now because the market has been so erratic over the last month and a half, 2 months, that there's still possibilities that we come back down and test the lower end of this range. But I would say right now there's a higher chance that we test the highs first and then figure out whether we're ready to really break through them or whether we find another big wall of selling that kind of stops the bulls in their tracks. And then if that's the case, then we're going to head right back down. Now, what are the levels to watch if we do head down? Obviously, to the upside, the only level we need to watch is 350 to 351 and beyond. But to the downside, well, we've got the 20 and the 50, which should be broken if we see some selling pressure because we're already right up to them. But as you can see, just below them, this 336 area is going to be a key support. Not only is it strong horizontal support, it's also going to be the bottom of this channel that the Dow has basically been trading in since the holiday season of last year, right? Since right around the beginning of November. And that hasn't really been broken. The moving averages have held quite a while now. And there's a very good chance that if we do pull back, we should still maintain this trajectory, at least for an initial bounce, and then we'll see what happens from there. And like I said, to the upside, we really only have this particular shooting candle or shooting star candle to really watch out for. The body of it, which the close was right around 349, and then the top wick, which is at 350, almost 351, and that'll be the key area to the upside that we need to watch. Now, everything I said for the S&P 500 for the most part stands with the Dow, so we don't really need to spend too much more time with it. The last index we want to look at is IWM in the small caps of the Russell 2000, and you'll note here, by the way, a very strong rally, and this is a nice catch-up move by the small caps to make their way back to all-time highs, and we are really just kind of a stone's throw away from printing new highs. And so again, this is, I think, one of the charts that's giving me a little bit more confidence in expecting a push through highs, is what I'm seeing with the small caps. The small caps have been lagging. They've been trading sideways, just like the NASDAQ. You'll note we've been kind of already been trading sideways for a while, since February. And if they are getting ready for a breakout, then particularly if the NASDAQ concurs with this, then it should lead to a new rally across the board, at the very least a 1 or 2 week rally, and get us to new highs and get us to a new area where we can go ahead and start turning and trading sideways. You'll note the moving averages have really coiled up together. Now, this is still not a fully bullish alignment with the moving averages. For us to really get excited about a rally, we would want to see the 20 start to climb and the 50 kind of spread away from it, and kind of create a very similar pattern to what we saw here way back in October of last year, where you had them kind of coil up, and then eventually when you start to see the 20 spread away from the 50 as they both start to climb, that's usually indicative of a big momentum shift to the upside. Now, of course, the moving averages are going to lag price, so price is going to break out before we see that pattern. But that's the pattern we want to see if we want to get kind of confidence in this momentum in this rally to kind of continue further along. So that is one of the things we're going to be watching, is how the moving averages react based off of course, what the price action is going to be. If the price action falters here and heads back down, well, the moving averages is going to stay coiled together. But if we do see a breakout, then there's a good chance we'll see that kind of play out, and we'll be at new highs, and we'll have a potential rally really start to develop. Now, the one negative as far as looking for a rally in the short term is, the IWM is actually it's already a little bit overbought. I don't have any stochastics or RSI up, but just generally speaking, you can see it in this pattern that's been developing. We got a little bit of a rising wedge as we come up to highs. This normally resolves in a kind of a quick pullback. Now, we did have a nice bull flag. We've had some sideways consolidation, so this rising wedge isn't really the end-all, be-all to an overextended market. It could be that this is still the beginning of a rally further upwards, and a lot of times this price action can sustain itself a lot longer than expected. But I would say this is the one part of this pattern that I'm not that excited about, is the fact that we haven't really had a nice consolidation sideways to build up enough momentum to break out. And so there's a chance that we still stall out at these highs, but like I said, I'm pretty sure from what I'm seeing here, it looks like all the market indices are going to make a play for new highs, and then what happens as we push through that is the big key. If we get a reversal, then I think it could lead to pretty good selling to the downside. But if we don't get a reversal, then I think we can get a good rally to the upside. And so, much like we've done for the last few weeks, I think that we're still at a situation right now where we need to be a little bit more cautious, because there's still pretty good potential for a move in either direction. Now, that being said, this week, as I said earlier on my Patreon post on Monday, was a more bullish-looking week than what we've seen in the last few. And so, if that plays out further along, then we should get maybe some good trading action in the near future. And I think the key again is what we want to do right now is we're still kind of riding out this volatility and waiting for better conditions. And these conditions are likely to come very soon, because we already have a potential for a breakout. And if we get that breakout, we should see a lot more equities start to behave in a little bit better manner and give us a little bit easier to trade chart patterns or trading setups. And on the converse side, if we have a breakdown here, then we'll have a pretty quick correction, and that should give us a good opportunity to trade after that correction is done, to have some good value trades as we find stocks at support that have maybe just had a big bout of volatility, so they can kind of quiet down and then maybe give us a good bounce trade. And so I think that we will have a little bit higher probability setups coming up in the next couple of weeks once we get a full resolution as to what the market wants to do at these highs. And so let's keep watching them. Let's watch these levels that I outlined and see what the market does as we head back to those levels, or if we break past them, as they should be the good points or the good staging points for us to go ahead and look at trades if the market does indeed correct. Or if it doesn't, then like I said, we should have pretty clean price action as it starts to rally again. If we look at the US dollar, we have a pretty interesting setup here. The dollar has been trying to bounce and it's been trying to stabilize, and it's been kind of failing at that. Even if we do see it slowly building up some momentum, you can see it broke a very short-term downtrend, which we outlined last week. It's still going down, even though it's got three green candles out of the last four, or last five, and it's still down from where it was just a week ago. However, I do think that this is still the beginnings of a bounce on the US dollar. And that could put pressure on the stock market, although they don't necessarily always trade inversely correlated, so I wouldn't put too much emphasis on it yet, at least as far as the stock market is concerned. But I would maybe put a little bit more emphasis on what kind of pressure it might put on gold and silver, and possibly even on Bitcoin and Ethereum. But the key here is, like I said, it does look like it's starting to bottom out, and it looks like it's going to try to bounce here and make its way back up and challenge the middle of this range to possibly the top of that range. If we look at the individual currency crosses, we'll see again signs of a potential dollar bounce. Now, this is the euro, and the euro is going to be inverse. This chart is going to be the inverse of the last one, or the mirror image. And you can see that the euro broke down, which is again showing signs of the US dollar breaking out, right? Because the US dollar was putting pressure on it, and we've got this breakdown, and then we came up, and as you can see with today's candle, we're really struggling to kind of reclaim that breakdown point, and have actually failed at this point. Any move below today or yesterday's lows usually resolves in a much stronger move back to the downside on the euro, which again would be a good move for the US dollar. So this right here is a chart that looks like it's really beginning to show some signs of strength for the US dollar. You can see as I extend this trend line out a bit where we are right now, and if we break back below that, I think it's going to be a quick move, probably all the way down to this 50-day moving average, and pretty quickly down to 121 and probably below, like I said. If we look at the US versus the Japanese yen, we'll see it's been kind of chugging along. This was one of the potential trades I outlined a few weeks ago, and it's worked out well for anyone that went ahead and took that trade. Even if you kind of held through this fade, which you shouldn't have, it's still working okay for you as it's starting to bounce now, and it's probably going to make its way back up towards the 110.2 area or so, and possibly even try to come back up to the area it topped out from. We look at the US Canadian. This is the one chart that maybe doesn't look that bullish, but I actually think this is actually a pretty bullish chart. And the reason I do is that the US dollar has actually held in a pretty stable range, despite the fact that crude oil has rallied. And we'll get into the oil chart in a second. But as you can see, the US dollar tried to rally versus the Canadian and failed, and has been stuck in a trading range. But as you can see, it's made its way from being under the 20-day moving average to being over the 20-day moving average. And the key here is that it's done all this while oil has rallied pretty significantly, going from the mid-60s all the way up to almost 70, and actually it was above 70 earlier today. And so even though oil is kind of inching its way upwards, the U.S. Canadian has been able to hold steady. And so I think that we're actually going to see a bounce here and a move back towards the 122.5 or so, 122.6. So any of you are Forex traders, whether you're watching this as a replay or whether you're here, if you're looking at this, this is probably going to be a good potential trade once it's able to break past this current level of resistance that it's really struggling with around 121.2 or so. And if it does that, it should be a decent move to the upside. And now going back to oil, I think oil is probably reaching a spot where it needs to take a break and come back and test its 20-day moving average or possibly 66.80. But so far, this is a pretty bullish move on oil. Again, indicative of increasing energy prices, which indicate a an attitude of increased demand, where the market continues to expect us to use more energy despite the fact that prices are going higher. This again is going to be a function of our economy opening up more, people flying more, people driving more, people spending more, and that's going to of course be reflected in our energy costs. And so far the market expects, even though with energy prices going up, particularly when you think about it, at the start of the year oil was trading at the mid 40s, and it's all the way up to almost $70, and the market still hasn't shrugged and it still thinks that we can basically sustain these prices going forward. So this is another big sign that the market still anticipates full recovery, economically speaking, and when, as long as that's the case, we're going to see oil kind of still hold strong. Now, if we start to see a little bit of struggle here, and we start to see signs of maybe the economy not being able to sustain this, we'll see a quick move down in oil. But for now, I would expect oil to just trade. When it does correct, I think it'll correct in a pretty orderly manner. I don't think it'll be anything really sharp or fast. It'll probably just kind of make its way back down and test its 20-day moving average as it starts to maybe extend a new rally. If you take a look at the moving averages, like I said before, when you see the 20 curl up like this and you see the 50 spread out below it, that's usually indicative of an emerging trend, very similar to, again, to what we saw here. And if that's the case, we could still see higher oil prices, which of course not something anybody really wants to see on a personal level, because we have to spend more money on gas and other stuff. But that's what it looks like is going to happen. Now, that being said, I think in the short term, oil is going to pull back and retest these areas. We look at gold and silver. You can see gold starting to stall out, again, because part of the reason for that is because of the strength that's coming into the U.S. dollar. If the U.S. dollar does get a strong rally going, then I think gold is probably going to get stuck trading in a range. Overall, this is still a pretty bullish chart compared to what it's done in the past several months, past half year or so at the very least, as it finally broke a pretty big downtrend and got back above its 200-day moving average. And it's doing this, what gold does is one of the reasons that I usually don't like to trade gold, is I don't like the way it consolidates, the sloppy nature of its ranges. This right here is not really a good trade either to the short or the long side. You've got as much downside as you have upside. So I'm still kind of waiting on GLD. I think if it comes back down and hovers around the 200-day moving average or down here around 174, maybe it sets up. But I think right now, with the vibes I'm getting from the U.S. dollar, I'm not really looking at gold or silver very much. You can see silver doing the same thing in a little bit more of a contracted manner. You've got upside to 26, but you've got downside to about 25 or so, and it's trading right in between that. It's trying to hold its moving averages. Now, again, the moving averages this is a good. This is a good pattern to see on a moving average, right? The 20 coming up, the 50 over next, and then the 200. Unfortunately, the 200 is not rising yet, but when you get this big spread between these moving averages, that's usually indicative of an emerging trend. So there could still be a good trend coming on silver, but in the short term, I don't like the pattern that we're seeing, and I don't think risk reward is in a good spot here. But just like GLD, I think that we are starting to see signs of tradable patterns on gold and silver. And then finally, the last, not really commodity, but the last kind of inverse dollar play we want to look at is Bitcoin and Ethereum. And you can see Bitcoin actually had a really rough last few days, and actually came down almost down to 30,000 again. It was trading right at 31 last night. Had some good buying today. Been a lot of moving back and forth on it, and it really hasn't been able to bottom out yet. Although it has established a good bottom, it hasn't been able to kind of reverse that and kind of use that as a staging point to rally again. And there's still the threat overhead of it possibly rolling right back over. But I think, again, today's candle, when you look at yesterday, on increased volume, it kind of stabilized, and with today's reversal off of that, I think that we are still forming a good bottom here. For those that maybe missed out on Bitcoin throughout the last year or so, this might still be a good spot for you to go ahead and take advantage of it as it's trading in the mid to low 30s. I think once it gets back above 40 and 45, it should make its way all the way back up to the 50s. The kind of volatility you get on something like Bitcoin means that you can easily go from 36 all the way up to 42 in just 1 or 2 days, and then all the way back up to 48 or 50, depending on the nature and just exactly how emotional the market gets on it. However, right now, like I said, this actually looks like a good buying opportunity, with the caveat that there's still potential for further downside and a potential rollover. However, I think the risk reward is more than worth it at these levels. And I think it's going to be the same case with Ethereum. When you go ahead and take a look at it, it's still trading basically almost half price to what it was recently. It's kind of dealing with its 20-day moving average. We've got this kind of double hammer candle forming, and it didn't make it, unlike Bitcoin, you can see the relative strength, right? If you go ahead and take a look at Bitcoin, Bitcoin came all the way back down and tested down to these bottom wicks. If you go ahead and take a look at Ethereum, Ethereum actually held and kind of didn't come back all the way down to support. So relative to Bitcoin, it's still showing more strength. Now today it's a little bit lagging because it's down. It's only up 3% as opposed to the 9% that Bitcoin is, but that's because it held up at a higher level as opposed to coming down and testing these lower levels. And so for those that are into the cryptocurrencies, it's been much more of a struggle over the last couple of months or the last month or so. But they're starting to maybe stabilize. And if that's the case, we could get some big moves on them. And the one thing I'd like to point out, if anyone in here is a swing trader, these have been very good moves back and forth if you've been active. To get from basically 2,100 all the way to almost 3,000, 29, you're looking at maybe 25-30% moves here back and forth that you can just kind of swing back and forth without having to really put on too much risk or even hold for too long. As you can see, it took 3 days, then it took maybe 4 days, and so that there's still really good potential here for swing trades on these that you don't see in regular equities. Okay, and so that's really what I wanted to cover with the cryptocurrencies for today. Those of you that are in here, if you have a chart that you want me to look at, feel free to type it in. I'm going to go ahead and review real quick a couple of the trades that we were looking at in Patreon under my blog post for Monday, and then we'll kind of wrap it up if we don't have any chart requests. So feel free to type something if you have anything you want me to look at. The first chart I want to point out is GoPro. GoPro had a very nice move yesterday. As you can see, we were watching this descending trend line, and this is exactly what I've been kind of mentioning when we were talking about the markets. Is when you get these really tight consolidation ranges as you deal with these resistance levels. This is a function of volatility, and this is exactly what I mean about volatility expansion to the upside. When you get these big expansion candles, that's usually a really good sign. And as you can see yesterday, we had a really good, I believe it was like a 9% move on one candle, and we were able to decisively break this trend. Came up past our first target, which was 1220, and made our way looking for our next target, which is going to be the 13 to 1350 range. This is a perfect example of what I like to look at. We have really good risk reward here when you understand what it is. Once you break this trend line, you understand that the lows from the last couple of days are going to be your stop out point, right? So you have a thing here where you could get in about 1150, and you have maybe about 50, 60 cents of downside. And you have $1 of upside to the, maybe 60, 70 cents to the first target, and then maybe $2 or $3 of upside to the next level. And this is the kind of trades that we want to look for, particularly when the market is being kind of picky and a little bit choosy with what works for you. You want to have decisive breakouts like this. You want to have clean levels that you can kind of get easy entries on. And so this has worked out really well for us. And the other one that's worked out really well for us is Whitestone. And as you can see, it had a nice breakout yesterday as well. Same basic pattern, right? You've got this nice descending trend line. You've got the price action getting contracting to a really tight range, and then you have the volatile breakout. And these are the good entry points. And as you can see, it led to a big move, and today it led to a pretty nice move all the way up to almost $9. And it's fading a bit now, but it gave us already a good move back to one of our target areas. And this should make its way back up to the 50-day moving average, which is one of the key areas that we're watching for on this. And typically when you get through the 20 like this with this kind of strength, you eventually make your way up to the 50, or the 50 makes its way back down, but eventually it will meet up with the 50, and that's going to be one of the areas that we're looking for. And so I hope this gives you a little bit of insight into what we're looking for and how I want to go ahead and structure my trades. I think the key here you want to watch for is the risk reward, and the fact that you have these clean patterns that give you really easy decisions to make. If it doesn't break this trend line, you don't even get in. You just wait for the break of the trend line, and then that's when you go ahead and you try to enter. And then again, if it fails, you have a very short stop out point, right? Again, if this breakout, you would have entered anywhere from 840 to 850, and you have a stop out just 25 cents away, which makes it much easier for you to go ahead and try to take a move, and even take quick profits, because your stop is so close. You're still going to make more on these quick moves than you would losing out. And so, as long as you have good risk reward like this, it makes it much easier to kind of navigate these waters, especially when the market is not giving you very conducive movement across the board. Alright, so that covers it for today. That's pretty much all I wanted to go ahead and point out. If anyone is watching this as a recording, or if you did not want to share anything during the Twitter stream, or the Twitch stream, you can always message me at Twitter under the name @StockDarts, and I'm more than happy to go ahead and send you a chart that way, or take a look at what you're looking at, or answer any kind of question you have, whether it's a pattern or whether it's an actual look at a chart or whatever it is. More than happy to go and help anyone out. All right. Other than that, hope you guys have a good rest of today, and we'll meet again next Wednesday.